SoFi has been getting punished alongside its fintech peers over the last couple of weeks. Check out our price chart here showing SoFi's history since it completed the SPAC and went public in June, where we're nearing all-time lows. So is it a buy yet? In today's video, while building a case for my Trey score for SoFi, we'll look through who they are, their growth potential, current evaluation, and a brief look over their financials, as well as a bit more on their management, memeability, and finally, since I live in Japan, the stock market is open while I sleep, and I love sleep, score as well. I should also mention up front, for your optimal viewing experience, that long story short, I'm pretty excited about SoFi now that we're at these price levels, and I've also gone ahead and added timestamps down below. My name's Trey, and here at Benevolent Investors, we aim to grow our money smoothly, all while prioritizing our families, causes we support, and those around us in need. So if you're not all too familiar with SoFi, their full name is Social Finance, and they've been around for a few years before their IPO earlier this year. Initially well known for super easy and manageable student loans, SoFi's rapidly expanding offerings menu has branched out to include brokerage accounts for investing not just in Wall Street, but also in crypto, along with all kinds of other loans like personal loans or mortgages, and all the way over to managing your money with high interest savings and checking accounts, to credit cards, insurance options, and many others. And from the beginning, SoFi's goal has been to connect the dots between what we all think of as legacy banks and all the convenience and handiness of fintech companies like Square or PayPal or even Lemonade Insurance. And with a super slick and easy to use interface, I personally have been pretty impressed. I've tested out dozens of apps and banks just out of curiosity, and SoFi has been surprisingly quick and easy to use. We'll get more into the actual figures showing their growth in a minute, but some neat ways they are aggressively attracting new clients include things like this, where once you just set up direct deposit, they basically microloan you your paycheck a couple of days before it lands, so you have early access to the funds for free. While I've never thought I would want to make out with a stadium before, SoFi Stadium in Inglewood, California, one of their brand recognition super weapons, kind of has me reconsidering my decision. Hosting the NFL's Chargers and Rams, this high-tech stadium has brought new evidence into the debate on whether or not sports stadiums can actually provide worthwhile results to companies willing to spend massive amounts of cash on branding through this avenue. SoFi's rapid growth and adoption may be a testament to the fact that quick and easy apps can benefit from these kinds of deals. In this case, it's a 20-year deal that cost SoFi $400 million. Here's another way they're attracting new clients. One of the hassles of spending so much of my time in Japan so often is that getting access to my credit scores is often a pain in the butt, but SoFi made it really easy and slick, and they paid me to do it too. So while we've talked at length about companies like Square or PayPal in the past on this channel, both who are fintech juggernauts with longer histories and market caps way larger than SoFi, SoFi is aiming to replace legacy banks in a similar way, but just coming at it from a different angle. Rather than starting with retail shops like Square or online payments like PayPal did, SoFi started with loans but is rapidly expanding. And their growth strategy kind of reminds me of Lemonade Insurance, who started out by offering like really easy to access and affordable pet insurance plans to young tech savvy folk who will eventually go on to add things like auto insurance, life insurance, and eventually renters and or homeowners insurance as well. And the plan is basically to get people while they're young and keep them for life. And the plan hasn't unfolded perfectly quite yet for Lemonade because it's so long term. It requires so much time. But like SoFi, they seem to be growing pretty rapidly. So taking a closer look at those figures, check out the number of members that SoFi is adding. Looks like the most recent quarters, they're hitting at least 90% year-over-year growth, which is hard for most companies to say. And along with the growing numbers of members, they're also multiplying the number of products in use at an even faster rate. That means that while someone may have come on board with SoFi for a student loan in their college years, they're much more likely to also add on other products like further loans or like mortgages in the future, as well as things like brokerage accounts, credit cards, or budgeting services too. Which CEO Anthony Noto says they're aiming to be the best in every single one of those categories, making it a no-brainer to add on more and more products. And the more that happens, the thicker the profit margins will get. And we're seeing that happen on this chart too. On the left, we're seeing gradual growth of lending products, But on the right, we're seeing that the transition to offering high quality financial products is exploding at an even faster rate, with year-over-year growth numbers often in the hundreds of percents of growth. We'll look into the finances more in a minute here, but it's really clear that they're growing, and from the largely extremely positive reviews I'm finding online, I don't think that growth is set to slow down anytime soon either. Quick note about their investing platform. It's definitely super easy to use and understand, and they've even made their own ETFs and automated investing systems for beginners, but they don't yet offer options or more advanced functionality, though they've been clear that they understand the demand for those types of products and options, and they're working hard to implement them. I think if they're able to pull off a user interface that's as easy to use and intuitive as their existing app already is, I really wouldn't be surprised if this ends up being a game changer for many, especially those looking for a reliable alternative to beautiful apps like Robinhood. And speaking of Robinhood, they want to make sure they set up everything really well so they don't end up getting leverage pinched like Robinhood did during the whole GameStop debacle too. It's clear they're growing massively, and there's still a lot more on tap from them, especially considering the rate at which young people are starting to get into investing in these last couple of years. So with that, I give SoFi a growth potential score of 10 out of 10. And speaking of CEO Anthony Noto, this guy's really sharp and has the perfect credentials to power SoFi to accomplish their ambitious goals. West Point graduate, where he was star linebacker on their football team, he managed to also be the highest ranked mechanical engineering major in his class. He went on to graduate from Army Ranger School, and then he went on to be a communications officer and eventually have 5 children too. His career later brought him into Goldman Sachs, where he excelled as an analyst, particularly specializing in the internet industry, and he eventually became a managing director in 2003 and a partner in 2004. And in 2008, he became the CFO of the NFL for a few years before heading back to Goldman Sachs for a couple of years. And then later on in 2014, he became the CFO of Twitter. He's made it clear that making SoFi number one is his life's mission at this point now. And while Noto's known for being a family man with a strong background of military ethical fortitude, he took over SoFi after the previous CEO, Mike Cagney, resigned after a sexual harassment lawsuit that shook things up back in 2017. And we'll touch more on how Noto's plans have affected the finances of SoFi here in a minute, but I'm pretty comfortable giving SoFi a management score of 8 out of 10. A solid 8 out of 10. The management's doing a terrific job here, and there really aren't many points I can call them out on, but I think they'll earn their keep in the coming years as we see what happens with the bank charter and their further growth into deeper financial offerings as well. And speaking of the bank charter, the way most banks work is that they make loans, basically using the money that other clients have deposited in their savings account or checkings account. But in order to do that, you need to have a bank charter, which is a very long and convoluted process. And SoFi's been working on it for a few years now, and there are signs that it could be coming together, as we're seeing things like this job offering for SoFi Bank starting to pop up on the net around places like LinkedIn. And so right now, when you apply for a loan on SoFi, they basically set things up and spin you off to another loan establishment company and take a cut of the profits. This business model is surprisingly not bad, and it's worked well for them up until now. But if they were able to lock down the bank charter, you would see the dual benefit of being able to offer even cheaper loans, as well as using the deposits they already have on hand to be able to fund those loans. Surely this will lead to more aggressive tactics like higher interest savings accounts, to bring in even more deposits, to be able to fund even more loans as well. Next, let's take a look at the financials, valuation, and memeability. While we've seen the stock falling apart, and like I mentioned in one of my videos last week, a rising interest environment is likely to bring pain on many tech stocks, if we're able to lock down the bank charter sometime in 2022, we may also start to see the reverse effect, where oftentimes financial institutions experience fatter margins in a rising interest rate environment because they can in turn charge higher interest rates for loans. Note the blue bar at the bottom of the chart here showing us the volume on SoFi's trades. It's starting to trade at volumes similar to market monsters like Apple on some days, and it's also all over the place on Reddit, Wall Street Bets, and Twitter. We've seen the stock explode off of news tidbits a few times in the past, and it's still small enough with only an $11 billion market cap that news events can cause massive price fluctuations. Generally speaking, it seems like the buzz on Reddit is pretty positive, with a lot of people excited about the future of the stock. Recent figures show institutional ownership of about 27%, which is probably neither comforting nor alarming, with a lowest short interest rate of 5.7%. I honestly thought that number would be higher considering both how memey the stock is and how trendy it's become on social media, but 5.7% is actually somewhat reassuring in my opinion. I was expecting it to be like 10 or 15%. So with that, I give SoFi a memeability score of 9 out of 10. And taking a look into the financials and valuation, while we've seen the stock as high as 23-ish bucks in recent months, we haven't seen it get much lower than it is now at just about 14 bucks. I think how it moves from here is largely going to depend on what the Fed ends up doing, especially in tomorrow, or I guess depending on where you are in the world, today's announcements on Wednesday. But I honestly wouldn't be shocked to see it go, below 12 or maybe even 10 bucks. On an adjusted quarterly basis, we're once again seeing strong net revenue growth. This isn't translating into adjusted EBITDA as clearly because of so much reinvestment in customer acquisition, but this shouldn't be shocking if you're looking into a company this young. But the figures look better when you zoom out to an annual basis, with strong net revenue growth carrying over into the adjusted EBITDAs, bringing us into positive territory. Now, all these figures are quote-unquote adjusted, so take them with a grain of salt. There are generally accepted ways you can quote-unquote adjust your figures, and some companies pull some very liberal interpretations, so let's keep an eye out for that. And here we can see how their loan business is shifting away from a student loan focus to boosting their personal and home loan originations, and thus their profit in the lending department. And arguably the more important segments of the business, the technology platform and financial services segments. Technology platform appears to be providing the majority of growth for the company and is primarily made up of the Galileo acquisition they completed in 2020. And this could be argued to be SoFi's killer app, so to speak. And it's one people overlook a lot when they're starting to understand SoFi, I think. So when you think of companies like Visa, you think, they're a large payment processor who works in jillions of retailers by handling their payments, right? And the whole payment processor industry is tricky because while it provides beastly margins for long-standing companies like Visa, it's not just a matter of slapping together some code and being done with it, right? Payment processing has a pretty high barrier to entry because there are already so many solid payment processors. Galileo is one of those, and it already powers 90% of all digital banks in North America, as well as the majority of the top 100 fintech companies globally, including Robinhood, dude. Pretty much all the big fintech companies use and are dependent on Galileo. And SoFi now owns them. More specifically, Galileo is a financial services API and payments platform. So similar to how if you started a brick and mortar store now, you might work with Visa or Square to provide payment processing. Most fintech startups would find it cheaper and easier to work with Galileo and just use their APIs for building their app or service, rather than building a team of software and finance pros to build something like that from scratch. And so when we see slides like this showing us that Galileo accounts are growing 80% year over year, that's not just within SoFi's own apps and ecosystem. This means that the Galileo segment of SoFi's business is powering 89 million accounts through other fintech services. And for every account, SoFi makes money and gains a certain amount of information that could be valuable for them going forward. So going back to the technology and platform segment, we're seeing profits from this portion of the business growing nicely. And the more the whole fintech industry grows, the more these figures will continue to grow because they're all powered by Galileo. On the bottom half of this page, we have the financial services segment, which is made up of cash management and investment services like credit cards and Relay. Though we're seeing strong account and revenue growth, I think it may be a bit longer before we start to see revenues eclipse the marketing and other expenses associated with growing in such a competitive sphere. Now, before you get too down on the financial services segment, remember that this segment brought 79% of new member growth and was responsible for 73% of the cross-buy. That's the key here, as we're hoping to see more users utilizing more of their various services, and this is the gateway to that. Now, we're already halfway to the next quarterly report, and a lot of the financials aren't necessarily super helpful at the moment because there's so many irregularities, like we were talking about earlier with those adjusted statements. But this income statement shows us that at least we're seeing the earnings before taxes, or EBTs, trending in a good direction. The balance sheet here shows us that while they've boosted short-term investments as well as PPE spending, our assets far outpace our liabilities. I know some people get excited about seeing massive cash and equivalents on hand, but I think SoFi's management's doing a good job of balancing the need to use their cash to keep costs down while avoiding getting into a situation that's over risky by having little or no cash on hand. And so while we're seeing a lot of positive signs, the recent price crash has brought both the forward and trailing PS ratios, or price to sales ratios, down to earth a little bit at 8.8x and 13.4x respectively. So just like when we're looking into other young, rapidly growing stocks like Skills or Desktop Metal or Palantir, it's hard to find much value in things like a low P ratio or a solid current ratio or quick ratio or things like that. You can't demand that from a company that's just churning all that it has back into growth, marketing, and customer acquisition. And that's why it's super important to keep in mind the long-term target is a 30 to 40% margin across the board through all of their products with strong leadership in all of their offerings. I did also want to mention real quick the street price targets, which I don't necessarily put a huge amount of weight into. Here you go. Because analysts are humans too. But we have a range of $19 all the way up to $30, with a majority of analysts calling SoFi a buy right now. Personally, like I mentioned earlier, though I'm super excited for the long-term prospects of the company, especially considering the Galileo acquisition and the bank charter, I wouldn't be surprised if we continue to see the price dip. I am buying in the 14s and will continue to buy in over the coming months, so long as we don't see a meme explosion launching it back into crazy valuations. After personally exploring the services app, I'm really impressed with just how slick SoFi is. It's not just a hype meme stock, and it's getting so much attention from investors because there's so much potential for growth. Now, like one of our other favorites, Palantir, we will also unfortunately have to deal with continued stock-based compensation expenses because you have to take care of your team with equity when they're building the company for you. I'm not nearly as alarmed as I've been with Palantir's figures, as you can see here, but these are important figures to keep in mind as you invest for the long term. And with that, while keeping in mind the overall market pressures that are bound to negatively impact this stock in the short term, I'm going to give SoFi a valuation score of a solid 7 out of 10. And while we've seen SoFi getting wrecked in recent weeks, I'm still very confident that their excellent products are going to be continuing to power growth long into the future. And frankly, I don't think there's a massive amount of downside left on the thing either. So with that, I give SoFi a, since I live in Japan, the stock market is open while I sleep and I love sleep, score of 6 out of 10. Now, before we add those all up and compare it to the other recent stock analyses on the Trey scoreboard, I wanted to show you a quick video of CEO Noto in a Citibank interview. It'll give you a good idea of where they're headed.
We are going to have a value proposition in SoFi Money that drives to primary accounts. We want to have our account be their primary account because the information that we get on a daily basis helps us better recommend and personalize offers for our members and how they make their lives better financially. In order to get there, we think the formula is pretty straightforward. We think absolutely you have to have early paycheck. Today we offer 2-day early paycheck. I'd like to do even sooner. Second, free overdraft. No minimum balance. No minimum spending requirement. Roundups. In addition to that, an interest rate. And I think there's an opportunity for us to do all the things that I mentioned, which we're doing today, and be more aggressive on interest rate. When we launched SoFi Money originally, we launched with a 2.25% interest rate. I think Fed funds rates at the time was 2%. People were shocked and appalled that we would give 2.25% interest on an equivalent of a checking account with no minimum balance, no restriction on the cash. I'm not sure we'll be up at that rate, but we'll have a very competitive rate that would cause someone to say, why am I doing checking with anyone else? SoFi gives me the ability to pay from my phone, set up bill pay automatically, do electronic pay at the moment at any point in time, use a debit card, have physical checks sent on my behalf, do person-to-person payments, do budgeting, plus free overdraft, plus no fees, plus roundups, and I get my paycheck early. Oh, and I get a 1% interest rate, and I have no restriction on my cash when I get the 1% interest rate. Why would you go anyplace else? We think we can differentiate the product really meaningfully. The second thing we can do, because we'll have a lower cost of funds, is that we can lower the interest rates that we charge on our loans, which has a productivity loop to it because the lower your rates are, the better the credit that you get. And then there's more products and services that person needs. So we could also use our loans as a way to drive direct deposit. So for example, right now on personal loans, as I mentioned, we give you a rate without direct deposit and then an interest rate on that personal loan with direct deposit. Every one of our offers across the company should include a standalone price or standalone offering, and then a better offering if you do direct deposit with us. And so that could be in invest, that could be in crypto, that could be in loans, and obviously it could be in credit card as well. So we'll leverage all those different ways to be better together to drive direct deposit.
And so with that, SoFi takes first place on our Trey scoreboard with 40 points, beating out all of the opportunities we've seen in recent weeks. Remember, this is all heinously subjective and basically just for fun, but it should give you an idea of how I personally feel about SoFi. None of this is investment advice, and probably a lot of the numbers on this chart would change if I were to redo these valuations now, because some of them are already a month old. So if you're trying to understand the different kinds of pressures investors have to deal with and consider in the market at the moment, check out my video breaking down 5 major hurdles by clicking here. I love you guys, and stay generous.